Higher long-end yields and a fresh oil spike are forcing risk assets to reassess both inflation and the cost of capital. You are watching vTalkInsight, Allocator's Lens Daily for July 30th, 2026, where we connect the dots across equities, rates, credit, and commodities from a portfolio perspective. In equities, the striking feature today is how resilient earnings and macro data are colliding with a tech and AI-led correction. That tension matters for portfolios because equity risk budgets are being tested even though headline indices are still only a few percent below their highs. Major U.S. indices have started to give background, with the S&P 500 recently down more than 1.5% on the day and the Nasdaq 100 already in correction territory. The index has broken below its 50-day moving average, and volatility, as captured by gauges like the VIX, has pushed back above the low 20s, signaling a more two-way tape. The pain is concentrated in AI infrastructure and semiconductor names after exceptional multi-year gains. Momentum in the AI trade looks weak, with no clear signs yet of stabilization, and investors are questioning whether enormous capital expenditure on data centers and chips will translate into near-term productivity and cash flow. The shock sell-off in Korean equities underscores how fragile these crowded trades have become. South Korea's Kospi index saw intraday moves as large as 13% and has shed around 16% over 2 days, driven by an earnings miss and higher capex guidance from SK Hynix and aggressive retail selling. At the same time, the fundamental backdrop for equities is far from weak. U.S. earnings season is on track for a 7th straight quarter of double-digit growth, with the latest quarter expected near 27%, and Europe is seeing some of its strongest earnings in years, with regional growth estimates around the high teens. Importantly, earnings strength is broad-based rather than confined to mega-cap tech. Equal weight indices and regional banks are outperforming. European and U.S. banks are reporting robust loan and trading revenues, and European energy and basic resources are leading thanks in part to higher oil prices. These forces are driving a rotation rather than a simple risk-off. Investors are taking profits in hyperscalers and chipmakers and looking to sectors that can benefit from AI adoption, higher rates, or stronger nominal growth, such as financials, industrials, healthcare, and parts of energy and materials. Looking ahead, the key equity question is whether this remains an orderly rotation or evolves into a broader de-risking if tech earnings disappoint further, correlations spike around central bank or Middle East headlines, or long-end yields push higher again. Turning to rates, government bonds are now setting the tone for every other asset class. The Federal Reserve kept the funds rate unchanged in a 9-3 vote, reaffirmed its 2% inflation target, but offered very little forward guidance. And that mix of a hawkish hold with murky communication has left markets uneasy. At the front end, markets have become more skeptical that policymakers will deliver further near-term hikes. Implied probabilities for a September move have fallen from around 70% to roughly 50%, and 2-year yields have dropped, reflecting doubts about the Fed's willingness to tighten despite persistent inflation concerns. In sharp contrast, the long end has sold off hard. 30-year Treasury yields have surged above 5.2%, their highest since 2007, with daily moves of 11 to 13 basis points and one of the largest 2-year versus 30-year steepenings in a year. Real yields are near yearly highs, with 30-year real rates close to 2.9%, and markets increasingly see the era of ultra-low rates as over. Neutral Fed funds are now discussed in a 3 to 5% range, and 10-year yields in a 4 to 6% range, underpinned by heavy fiscal deficits, rising government borrowing for energy, defense, and technology, and intense global competition for capital. For allocators, this means traditional bond hedges are less reliable. Nominal and real yields have logged some of their largest between meeting increases in 2 decades, and volatility in long maturities is being driven as much by shifting term premia and fiscal concerns as by policy rates themselves. The debate now is whether rising long-end yields are doing enough tightening to let the Fed stay on hold, or whether they instead signal that the market expects the central bank to hike again to restore inflation, fighting credibility. Upcoming personal consumption expenditures data, which are expected to show core inflation still in the mid-3% range, and any further oil shocks will be crucial for how this rate story evolves. In credit, the strain from higher yields and heavy issuance is becoming more visible, especially around technology and AI-related borrowers. Spreads have widened in riskier corporate bonds, and even large investment-grade names like Oracle are trading at levels more typical of lower-rated credits, signaling growing investor caution. Hyperscalers and AI infrastructure players are at the center of this. Rising long-end yields and wider spreads have pushed up the all-in cost of capital for data center and chip investments, just as capital expenditure plans at firms like Microsoft, Meta, Alphabet, and SK Hynix are accelerating, and negative free cash flow prints have sharpened focus on return on investment. The supply pipeline is substantial, with investment-grade markets facing significant new issuance through 2030 and a surge in long-dated corporate and sovereign capital raising. Most deals are still being absorbed, but spread curves are steepening. Bond managers are favoring the short end of the curve, and there's growing reluctance to add exposure to tech and AI debt that is increasingly correlated with equity market swings. For multi-asset portfolios, credit is the key transmission channel between higher real rates, equity volatility, and the real economy. Widening credit default swap levels, tighter collateral terms for hedge funds concentrated in AI trades, and questions about private credit exposures in European banks are all signals to watch for any shift from orderly repricing to more disorderly stress. Commodities, and oil in particular, are amplifying both inflation risk and policy uncertainty. Brent crude has jumped roughly 4 to 7% to the high 80s, nearing $90 a barrel, after renewed Middle East tensions including Iranian missile attacks, U.S. and Saudi retaliatory strikes, and threats to key waterways. The risk of disruptions in the Strait of Hormuz and potential new fees on tankers in the Red Sea have lifted geopolitical risk premia and injected fresh volatility into energy markets. That volatility is feeding directly into inflation expectations and central bank outlooks, while also supporting equity sectors such as European energy and basic resources. Beyond oil, copper is outperforming gold, helped by strong physical demand from the U.S. and China, data center expansion, and constrained supply that could be further disrupted by El Niño. Gold, by contrast, has come under pressure from central bank sales and higher real rates, underscoring how commodities are splitting into growth-sensitive winners and traditional hedges that are struggling in a higher-yield world. Inflation volatility and repeated supply shocks are also boosting interest in infrastructure and other real assets that offer inflation-linked or inflation-resilient cash flows. For allocators, the path of oil and industrial metals from here will go a long way toward determining whether central banks can stick with a hawkish hold or are eventually pushed into another tightening phase. Putting it all together, equities are transitioning from a narrow, AI-dominated advance to a more volatile phase where strong earnings and solid labor data coexist with a meaningful tech correction and higher dispersion across regions and sectors. Rates are the fulcrum. An aggressive steepening of the Treasury curve and long-end yields at their highest since 2007 are tightening financial conditions, questioning the Fed's reaction function, and eroding the cushion traditionally provided by government bonds. Credit is where these pressures meet balance sheets, as widening spreads and a higher cost of capital challenge the sustainability of very large AI and infrastructure capex plans, even as most issuance still clears the market. Meanwhile, oil and industrial commodities are translating Middle East tensions and the data center build-out into inflation and term premia, with copper strength and gold weakness offering a clean snapshot of growth optimism versus safe haven demand. For allocators, the key watch points now are the upcoming inflation data, further signals on central bank resolve, AI, capex guidance from large tech, and any escalation or easing in Middle East supply risks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.